Spring is sprung, the Bund is riz. I wonder where the yield is. Just like last year, as winter turns to spring, Bunds are on a tear. Yields on the 10-year debt, a benchmark for Europe and indeed for world markets, have plunged to 0.1%. Bond markets globally have gone through the looking glass. Japan can now issue shiny new 10-year bonds at a negative yield, which means investors knowingly pay a fee to own it. German yields are negative out to 9 years of maturity. Crazy though it sounds, it looks like Germany's 10-year debt is next. The world is betting that deflation is here to stay, and big central banks will keep on buying bonds and/or cutting interest rates below zero in response. Last year, of course, the rally in bonds that came with the start of the European Central Bank's latest bond buying programme was very rapid, and it stopped short of yields hitting zero, just. This time, the pace is steadier, speculative herding is lighter, and zero or lower is seen as perfectly achievable. In part, that's because the Eurozone is back in deflation and the ECB is expected to respond with a fresh cut to the deposit rate in just over a week. But that's not the whole story. At this rate, markets are betting that Eurozone inflation won't hit even 1%, even in 5 years. We have a whole series of macroeconomic shocks, from China to a US policy mistake to Brexit, all baked into the price here. If investors cheer up even a bit, then last year's rapid fallback in bonds could be set for a rerun too.